Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. You know, if you wanted to find outperformance and alpha since the pandemic, the first portion of the markets that you looked for was growth stocks. You know, a large percentage of broad equity market performance has been attributed to the Magnificent Seven. You know, we have AI, you name it. It was all about growth. Well, I have on the perfect guest to talk about growth investing and his very interesting view and thesis on growth investing, which is a little bit different maybe than your typical growth manager. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Michael Sansoterra. Michael is Chief Investment Officer, Managing Director, and Senior Portfolio Manager at Silvant Capital Management. Michael, thank you so much for coming on the show. It's truly an honor to have you on. Can you tell us just a little bit more about yourself and Silvant Capital Management?
Sure. And Ryan, thank you. I appreciate it. It's a great honor to be here as well. So I've been in the growth equity business for 28 years, my whole career, and been an analyst, been a director of research, been a portfolio manager, came to what is now Silvant Capital Management in 2007. And we started the growth boutique here. It's owned by Virtus Investment Partners. So we're one of the Virtus Investment Partner boutiques. And all we do here at Silvant is growth equities. We just manage assets and our clients. I've been managing the large cap growth strategy since 2007 and lead PM on our focus strategy since 2015. So just enough time to be dangerous, I guess.
Fantastic. So a true growth shop.
Absolutely.
I love it.
Yep.
You know, it's been, like I said, a good period of time to be a growth investor since the pandemic. But recently, there's been a shift in market dynamics really since the beginning of July. So it's been a recent shift, and now value stocks have outperformed. Do you think that has been like a healthy shift in sentiment? Maybe bring down some prices, you know, normalize some of the markets, and what has been the driver of that shift?
I think anytime you get any additional market breadth after a period of less than stellar market breadth, that's definitely a good thing, right? You want to see all boats rising to some of the tide, some of the time. That's just healthy equity management. From a valuation perspective, I think part of that was due, by and large, to the larger outperforming stocks, particularly as you mentioned, the largest cap stocks in the Russell 1000 and growth index, outperforming for so long. We had a good 6 quarters of outperformance, that the dichotomy between large and small, the dichotomy in returns between growth and value got really wide. What's interesting about that, though, is it's very rarely a good timing indicator. It happens to have worked in July, and it felt a lot like a trading positioning, right? You're taking a break on some of these winners that are up 100, 200, 300% in the last year and a half, and you're getting an opportunity to spread it out, right? Lower your risk a little bit, buy some down and outs. Those companies may or may not execute well. In fact, I think by and large, the small cap stocks fundamentally still struggled into the quarter, but still, investors taking a little bit of money off the table when you have profits, that's healthy. A broader market with more more participants doing well, just from a stock price appreciation standpoint, also healthy. But what you're left with ultimately is, I think, the fundamentals. You can only run from the fundamentals for so long. So you come back to who's growing, who's taking market share, what types of companies are exceeding expectations that are kind of already built into the market.
I love that you brought up the breadth of the market and how important it is. We've had the S&P 500 has been concentrated in the top 10 stocks, like right. 30% of it, something crazy. But I've often talked about, that breadth is so important. But if you go back in history, there's a lot of other times where the concentration, maybe not to where it has been, over 30%. But markets have been concentrated in the past. So I'm glad you brought up the breadth and how important it is for market, performance to be sustainable. You need more than just seven names to carry it.
You do. You really do. It's important to note too that you know part of the time when things are really changing, right? And that's what you saw over the last year and a half. When you're seeing new markets be born and other older markets get disrupted, AI for technology, GLP-1s for healthcare, you can expect those types of swings. You can expect those types of immediate winners and immediate losers. And some of it'll be overstated. But it's important to remember that even those long-term solid sort of theses and investment strategies where you're going to own these stocks for a really long time, they don't grow to the sky. They have to take a break. They have to take a breather. And that's absolutely healthy. I think you nailed it. It's good for breath, but it's also good for those stocks. They can't go up every day. You don't want them to go up every day. We'd be back into the March of 2000 window, and I lived through that already. I'd prefer not to repeat it.
I'm that's a perfect segue. I'm really glad you brought this up because during the pandemic, there was a fear of missing out. You had, the meme stocks and all that stuff. And, it wasn't about the fundamentals and long-term investing. It was about day trading and just,
right.
Money was free. People were getting these free paychecks. It just, grew from there. Can you tell us maybe a little bit more about that difference between, why you should focus long-term investing versus just trading or, fear of missing out, just trying to find that big winner each day?
Yeah, I think, there's lots of different ways to make money in the market, and I try never to poo-poo any of the ones we don't do here too much. But I will say that the difference between investing and trading is trading is a bit of a blood sport, in my opinion, and it's very, very hard to do it well in any short given period of time. And I think it's pretty difficult for most investors in a longer period of time as well, because you're trying to react to things that are not sustainable, right? You're trying to move with trends very, very quickly. Unless you're really watching the screen 24/7, you're going to struggle as more and more information disseminates around the globe faster and faster and faster. So I think trading in that sense just gets harder and harder. I feel I'm always reminded of when I worked in Chicago during the bubble when I was a tech analyst, and we would my friends and I, guys I worked with, we would walk to get our shoes shined, even though we all shined our own shoes because we were all like junior guys. But we would go get our shoes shined once in a while as a special treat, and we would pass a bunch of guys that did that to get to the guy we liked the most, right? He hustled the most, he did the best job, he had the best prices, and we just liked talking to him. And when we'd see him trading stocks on his laptop, and we'd have to wait after walking 4 extra blocks and passing 5 other guys that did that. And he's like, hang on a second, I'm buying Cisco, and then I'm selling JDS Uniphase, and I'm doing these things. And I remember thinking, this has got to be done. This has got to be the end of that. When the trader mentality takes over, when the media takes over, when you finally come to that spot, that's when you know there's a bubble happening. Those for us are the clear signs. When that behavior changes, when anyone thinks they can trade, when anyone thinks they can make that, sort of free money, if you will, which of course there is none. Whereas investing, which obviously is what we do here, we're buying companies. We're shareholders in companies. We're looking at, companies that can exceed investors' expectations, right? And we talk a little bit about that, but more importantly, what is growth? What is growth to us? Growth's a condition. We're looking for these companies that can grow, can take market share, disrupt markets. And we've owned some of these securities for 1, 3, 5, even 10 years, depending on the stock. So investing is very much a different process than trading. Again, I don't belittle anybody trading. I certainly don't. I don't know if my guy's still shining shoes there. That was 24 years ago, but I feel like he was having a moment, and I suspect often that moment ends poorly because it just gets to be too much, and you don't know what to do on the flip side.
Well, let's hope that guy is now like maybe shining shoes on the beach, enjoying a pina
I
colada.
hope, I completely hope he is. Yeah, he should
Yes.
have someone shining his shoes, and that's how you move forward.
I would never be a trader. I just don't. And good for them if you're able to be successful. I love that you talked about, that's such a perfect example because during the pandemic, you had all these people coming out in Barstool Sports, Dave Portnoy, right? The
Yeah. Oh yeah.
Daily Dave trading or whatever he called himself, and stocks always go up and all this stuff. It's like, okay, yeah, always saw these memes where, the Fed's gotta raise rates again, or so,
Right.
um, to
Keep
get rid
feeding
of
the
this free
beast.
money and get rid of some of this stuff. And it also goes back to um, Warren Buffett, be greedy when people are fearful, and be fearful when people are greedy. So great example.
Yep. Makes sense to me.
You talked about the large growth space and
Yeah.
finding inefficiencies. This was one of my favorite questions when I get to speak with portfolio managers and asset managers like yourself. Where do you find inefficiencies? Where do you locate market inefficiencies? It's so important as an active manager to find them with conviction and stay consistent with those inconsistent in that large growth space. It's fairly efficient. So
Yeah.
where do you
Oh,
find them?
absolutely. Yeah, no, as I say, you're right. It is on a relative scale. It's probably the most efficient part of the market. So a lot of folks index it, and I can understand that if you don't have the time or the wherewithal, it can be very hard to outperform over a cycle or in any given window of
Mhm.
time. For us, the way we look at the world, we look at growth a little bit differently, I think, than a lot of other managers. Number one, and number two, we're really looking for the companies that can exceed those expectations right away. To your point, when it's efficient, that means that there's a lot of people looking at this space, a lot of smart folks on Wall Street analyzing these companies, very, very well. So, to pretend that you have an informational edge or that you've got some, line of sight that other people don't have is probably pretty unrealistic. So your goal really needs to be, where is it not priced in properly? Where do people not appreciate the information they have? Because we don't have different information. We just don't. I can promise you we can never outmodel the guy at Sanford Bernstein. I know him real well. He's way smarter than me, so he's never going to beat them. But you might draw a completely different conclusion from the same data, and that's what you've got to build a process to do. So what we do here at Silvant, our goal really is to identify those companies where we think the expectations are wrong, and the more
Okay.
we think they'll be wrong, we call it the wrongest for the longest. That's where we get really interested in, okay, if that's the case, what are the conditions for growth at this company? How can we measure its fundamental businesses, its key metrics, and how can we build a portfolio that's got multiple themes so we don't go too far down the road with any one particular idea? Um, that 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 helps us build a process that becomes very stock driven,
Okay.
Ryan. And then ultimately, when we work as a team here, we're based in Atlanta, Georgia. We got a team of folks. The team is a very flat team. So I'm in charge. It's not a democracy. I kind of call it a benevolent dictatorship. But I'm a big fan of the fact that all of us are smarter than any one of us. So if we are always looking for those stocks in the same way, we're doing that over and over again, we know that that process is repeatable. If it's repeatable and consistent, we can make it transparent. If it's successful, it will show results. So you've got to really do a handful of things, I think, to find those inefficiencies. And it starts with deep knowledge of the space. It starts with a very disciplined process for picking stocks, and then ultimately portfolio construction. I mean, I think that's drastically probably no more important now than ever before, particularly in the large cap growth space. Think about the Russell 1000 Growth Index, which we're benched against from an institutional perspective. You've got three stocks that make up a third of the index effectively, right? I mean, three stocks are a third of the index. So if you get those wrong, you got to get a whole lot of other stocks right. And that's been the challenge for so many large cap growth managers for the last year and a half, is getting two stocks wrong in there, and you're dead. And that's just been a challenge for just a lot of managers. So it's not an easy spot. I would argue it's never been an easy spot, but it's certainly not getting easier. But it's still completely tackleable. It's a solvable problem. You just have to you got to move with the times a little bit on it.
I'm really glad you brought that up about, being very difficult when the Russell 1000 growth is made out, huge weighting to those two stocks. Yes, you would like to, and have those two names part of your portfolio, but then at that same time, then your tracking area gets reduced, and all of a sudden, are you kind of a closet index fund then? So you probably got to be careful of incorporating those big names when there's a big overweight.
You do. And the way we look at it is, if you really like a stock, right, then you should have an active position in it.
Mhm.
regardless of its size in the index, you should
Okay.
be active. If you tell me you like NVIDIA, but you've got an 8% position bench against the Russell 1000 growth index, I will tell you that your positive conviction on that stock is going to lead to your underperformance. If you're right, you'll be wrong from a performance perspective, right? Because if you've only got 800 basis points of a 1,000 basis point position, and it outperforms, you lose. I mean, you effectively lose alpha. So for us, it's been, we've had success in this window because we are not afraid in the focused growth fund to make large stock selection decisions. So we can say, look, we're going to own 200 basis points above the index weight, 300 basis points above the index weight, whether the index weight is 30 basis points or 1,300 basis points. And that's a very big decision you have to make. You've got to really know where that inefficiency lies, and then you got to, of course, be right. But that stock picker's market mentality is very much where we've been, and that's, I think, part of the reason why so many people have lagged. It's just they just struggled. It's been a tough space for quality growth managers and other types of sort of style bias managers. If you miss one or two stocks, to your point, it's just really hard to outperform.
That's really interesting. So it is, we look at, sometimes you might look and say large growth, they've been performing so well, outperforming, but that it's a harder bogey than to achieve as a large growth active manager.
It is. I mean, it can be. It kind of depends, right? I never again. I don't want to slam small cap up. I've struggled. I can struggle in small cap or mid cap too, but large is just more. It's on the margin more efficient, right? Just on the margin, which is why mid cap is attractive to a lot of managers. We have a mid cap growth strategy here as well, but the opportunity sets are still everywhere, and the trick to outperforming is really understanding what's priced in and how do you really measure growth. I think another issue too, Ryan, is a lot of managers have been sort of absolute in their investment policy statements, or their clients have had these statements that are very sort of staid, if you will. And we had the same problem when I joined this firm 17 years ago now. And, we had these old IPSs that were folks saying, hey, you can never own more than 5%, like static number
Yeah.
of a stock. And that was a great rule to write in 1989 for that particular client, but that rule doesn't hold. So we've had to go back to those separately managed accounts, institutional accounts, and redraft those strategies to let them to talk about active share, right? Or, percentages above the position in the index. That's also somewhat freeing, and that's, I recognize that's hard for RIAs to have that conversation with clients, particularly older clients that are like, no, I like this right where it is. And a lot of times wealth preservation demands that. But growing and beating the index for us, adding alpha is the most important thing for us. So we have to find ways to bring our clients along with the times as well. And I know that's a challenge for folks, but we do custom portfolios with some of them that have still those very staid rules. But left unencumbered, you're going to always have your best chance of outperforming, particularly in large cap.
Fantastic. Real quickly, before I want to touch on and talk about your condition versus category in terms of your growth view and your thesis and your strategy. But I love that I talk to a lot of financial advisors about doing due diligence and searching for the correct manager to fit their practice and their clients. And one of them is make sure they're convicted, they have conviction in their style, and the whole team has that same messaging, and the performance and the analytics matches that messaging. And you mentioned it earlier about how your whole team is consistent and convicted in that style, your growth style, so you guys are all on the same page. And that's exactly, as an investor, what you want from your investment management team.
Yeah, I couldn't agree more. I've worked at different shops through my career, and when you put your growth hat on, if you can't have any other hats in your closet. Like you can't have closet value people on the team, or people that like to buy turnarounds, or they've got these dispositions that are against the idea of what growth is. The best, most cohesive, again, most consistent, repeatable, transparent teams are going to be built with people that all row the same direction all the time. You shouldn't have to convince anybody of why you're doing what you're doing. In fact, if I get hit by a bus and Sandeep Bhatia or Brandy Allen comes and sits in the same seat, they're going to tell you the exact same thing with the exact same people. we're very fortunate here because we don't have a lot of junior people. We're a relatively small team. There's 8 of us, but we don't need more than that. We can cover that, and we don't have anyone that doesn't have, you know, a decade to 2 decades minimum of experience in their space. That's the key. But you got to find those people. You got to retain those people. You know, when you're looking at managers, you should be, you know, I think your viewers should be thinking about how long has this team been together? You know, how well have they had success? When have they underperformed? Why have they underperformed when they underperformed? And are they still, you know, are they going to do what they did yesterday tomorrow? Right. That's the biggest trick for me. I'm like, you had a great year last year. Congratulations. I didn't own your shares. Right. How do I know you're going to do it again next year? I think that's how you get there. I think you're right. I think you've got to really understand the team.
Yeah. So let's talk about that condition. This really intrigued me when, you know, I was studying your firm and yourself, the condition rather than a category when you think about growth investing. Can you explain that more,
Sure.
please?
Yeah. If you think about that philosophy, these companies that exceed investors' expectations are the ones that outperform. You're left with a broader range of, you know, what really are expectations. Wall Street numbers, management numbers, buy side numbers, whisper numbers, hedge fund
Mhm.
numbers. The reality is the stocks are pricing in all of that sort of all the time. So you really got to have an understanding of what expectations are built into a stock. And when you do that, you ask yourself, okay, if we're looking for growth, well, what is growth? What does that really mean? And a lot of the old ways of managing that were, well, you've got to be growing revenue by at least 10% and earnings by at least 15%, and then we'll consider you growth. But if you stop and back up a little bit, and this is what we've tried to do here, is you recognize that growth isn't a category, it's a condition. Growth is a condition. And that means that any company can grow. If it's a condition, like a plant, like the sun, like anything else, then anything can grow. And some companies may never grow again in your lifetime or mine, but they could. And I'm always reminded of Apple Computer when I was an analyst and would look at that company in the late 90s. It was a failing PC manufacturer with a very small market share on the verge of going out of business, right?
Mhm.
Not only was it not growing, it was shrinking, coming close to failure. And then it would become the largest growth company in the world, which is a hell of a turnaround if you stop and think about it for a second. And that required massive innovation, right? That required them to, in many ways, really put the core of what they did off to the side, PCs, and start massive innovation of other products, which many companies have tried and failed, right? But Apple did a better job. And in that spirit, in that idea that any company can grow, and you're looking for companies that can exceed investors' expectations, you start to realize, well, heck, maybe a company that was supposed to grow 5% but grows 7 is a better stock than a company that was supposed to grow 30% but grows 31. Suddenly
Mhm.
that fixed number of 10% revenue, 15% earnings looks about as silly as 5% position size when you've got 10 and 12 and 13% positions in the index, right? It's a staid behavior. So our view on growth's a condition, not a category. Any company can grow. So we're going to look not just at the secular names that we own, that many of our competitors own, but I think investors should be looking at cyclical growth. All the while they're looking at secular growth, right? You can own General Electric right alongside Meta. You can own both, and they can both be growth companies, even though they're not anywhere near growing the same idea in the same exact magnitude or even the same reasons. Cyclical growth companies are completely fair game to our strategies at Silvant, recognizing that are they going to exceed investors' expectations? Are there key metrics, those fundamentals that drive that company stock specifically? Are they accelerating? Are they inflecting? That condition is somewhat, not only does it broaden our market, it somewhat relieves us from the concerns of what the market does. It allows us to stop worrying about, is quality growth going to outperform beta growth? Is GARP growth going to outperform, small cap value? We don't need to worry about that. We need to focus on where is the change and define the change more broadly, so we recognize sometimes a company that grows 2%, but the expectation was it would shrink 10%, is a far better stock if that can continue for a year or two than a stock that could have grown 20, but then really only grew 19. But gosh, that's still good. Well, is it? Because the expectations were higher, right?
Right.
I think that growth as a condition frees us, if you will, from being concerned about these things that don't add alpha and absolute returns, highest revenue, highest earnings. We know those ideas only work when it's a go-go market, like beta, like momentum. You want to have an opportunity to outperform in any market condition, so that if the style bias of well, quality growth is a great example. If the style bias of quality growth is out of favor for 1 year, 2 years, 3 years, we all kind of shrug and say, well, it's quality growth. We're going to stick with it because sooner or later it'll work. Our clients would prefer more opportunities to work when their style bias is not in favor. And I feel like growth as a condition alleviates a lot of that style bias concern. We will buy quality companies, don't get me wrong,
Yeah.
but Ryan will buy low quality companies too, right? Stocks that people think are a lower quality company, maybe because of the debt on the balance sheet or inconsistency of earnings or windows of negative free cash flow. Pick your reason, because that's another term. It's pretty broad definition of what quality is. But growth as a condition means you can look anywhere. And when you can look anywhere, you don't have to cheat the style box. We're not talking about that. We're just
Yeah.
talking about recognizing that expectations are really what matters in an efficient part of the market. Find the places where people don't think it can continue. And that's where you can own stocks for 1, 2, 5. Like I say, we've owned some stocks for a decade.
I love that, Michael, because we have that 9 style box, and you brought it up, and I personally kind of think, okay, we should evolve from that, because at the end of the day, we should look at the clients and the investors and it doesn't matter where the stuff, as long as they're achieving their risk and return objectives, building an optimized portfolio using any type of growth, if it's a growth fund, it shouldn't really matter, if it's a growth fund with quality, or maybe it doesn't have the quality balance sheet like you mentioned, as long as it's achieving the goals, right?
Right.
Doesn't matter if it's alternatives or whatever. I love that mindset. It keeps a much more open mind than boxing you into that corner.
Yeah, I think we become comfortable with the things we know. So the Morningstar boxes and Russell's definition of growth and value, it just makes sense after a long enough time. And then when you stop to think about some of them, and you recognize that pretty much every large cap manager's stocks are outside the box now. I mean, that should tell us something, right? The box isn't measuring the way it used to measure. That should be a yellow flag. That should be a yellow flag when you're not in the box, but you know what I mean. Maybe we should change what the box says, right?
Yes, why did it?
Russell's an amazing consulting company, but they don't have a magical formula on what growth is, and at least certainly not to us. And these minimums of got to grow this by this, it really ignores what's already priced into the market from a stock selection perspective. So
Yeah.
I agree. I don't know. I'm not saying I'm ready to throw out the box
Yeah.
scenario, but I think it could definitely be made better.
And exactly, there is a reason for it, and it's still very useful. I'm sure endowments and stuff like that, like the boxes, so they're, you think they're uncorrelated assets, which correlations have increased. So,
Right.
but they're useful, but at the same time, it's like, if I need a 6% return at lower risk, how do I get it?
Right.
Uh,
Right. How do I do it? And and
yep,
and and how do I know it's not correlated? And you need to run regression to know that, right? And I
yep,
think you should do that, if you can. And I know it's a lot of work, because I'm not making light of that either, but you should be looking at that across, if you're managing those assets with your clients, strategy by strategy, right? How
yep,
correlated are these, and how closely, are they behaving the way they're supposed to, right? Because a lot of the times, that analysis is very statistical in nature and based on history, and we all know that works until it doesn't, right? We all use the same risk control tools at the portfolio level, at the macro multiple portfolio level, and there's a risk there. There's always a risk there that relationships changes, and I think that's been another part of the issues with a lot of managers this last, call it, cycle, right? We've had a lot of changes in those behaviors. All the
exactly.
things we could count on. Oh well, the yield curve is inverted. We're going into recession. Well, no, no, that didn't happen. So now we're like, well,
No,
when the yield curve uninverts, that will be it.
then
Maybe, but we'll
maybe.
see. History never sings the exact same song, but it usually rhymes, right? But the
Yep.
music's been changing, and it's hard. It's a challenge. It's a challenge for everybody. You kind of gotta move with it.
you brought up regression and finding uncorrelated assets. This is my plug for Zephyr. You know, you leverage Zephyr. We can do that in seconds and find out, making sure those portfolios we're locating uncorrelated assets. Real quickly, how can financial advisors gain access to your thoughts and your investment philosophies? I find them very intriguing. I
Sure.
love your thoughts. Where
Oh,
can
thanks.
financial advisors and our listeners get more information?
Sure. So, Silvant Capital Management is a division of Virtus Investment Funds.
Yep.
Virtus is traded on the stock exchange, so that's all public information on the Virtus website, on the Silvant website. We have mutual funds, focused growth, large cap growth, mid cap growth. We also do SMAs. We have the ability to do model portfolio delivery, UCITS, CITs. Basically, there's no format we can't work in based on the assets and the interest. So yeah, you can find all of that on either the Virtus and or the Silvant website. Again, shows our tickers, and you can go into Morningstar and see the Virtus Silvant Growth Fund, the Virtus Silvant Focus Growth Fund, Large Cap Growth Fund, Mid Cap Growth Funds.
Awesome. Michael, very fun conversation. I love talking about growth, especially when you got a different tilt to it and
Thanks.
thesis. It's very interesting. So thank you, Michael, for coming on the show. It's such an honor to have you on. I really appreciate it.
Quite my
Thank you,
pleasure.
everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a good rest of your week.
Thank you.